All right, let's dive in. We're not here today for a typical accounting class. Nope. We're here to build a valuation framework, and we're going to use one of the most misunderstood tools in all of finance to do it, the Consolidated Financial Statement. Think of this as turning a simple compliance document into your own personal competitive edge.
So let me ask you this. When you see a consolidated statement, what do you think? Is it just a chore, a regulatory hurdle your team has to jump through? Or is it something more? Because the sharpest minds out there, they see it for what it truly is, a strategic X-ray of a company. It reveals everything, their ambitions, their hidden risks, the true economic reality of their operations. Let's start by putting on the right pair of glasses.
So for our first section, we're going to focus on adopting that investor's lens. This means we've got to make a fundamental shift in how we think. We need to move away from just looking at the rules and regulations and start focusing squarely on making smarter capital allocation decisions.
And this slide really gets to the heart of it. Look at the contrast. An accountant, and they do their job perfectly, follows the rules to combine the financials of a parent company and its subsidiary. But an investor reads between the lines. They look at this newly combined entity and they start asking the real questions. What does this whole structure tell me about management's grand strategy? Where are the real tangible synergies going to come from? And maybe most importantly, what new risks are now hiding inside this bigger, more complex machine?
Okay, let's move on to section 2, which is all about decoding the acquisition story. You see, the real narrative, the real drama in consolidation, it's almost always written during mergers and acquisitions. This is the moment where a company's strategy, its valuation discipline, or lack thereof, and its vision for the future all get quantified right there on the balance sheet.
Let's kick things off with goodwill. Now, it's so often just dismissed as some kind of accounting plug figure, but honestly, that's a rookie mistake. Goodwill is management's explicit, quantified promise to the market. It's the exact price they were willing to pay for future growth, for a dominant market position, for synergies that don't even exist on any balance sheet, at least not yet.
So when you see a massive goodwill number on a balance sheet, say $10 billion, what is that really signaling to you? Come on, it's not just a number, it's a direct reflection of management's ambition, their rock-solid belief in an acquisition's potential, and crucially, their discipline, or maybe their lack of discipline, when they were in the heat of making that deal.
A big goodwill balance tells you 4 things, instantly. Number 1, this company has a really aggressive M&A strategy. 2, they are more than willing to pay a hefty premium for growth. 3, there is a very, very real chance they overpaid. And 4, the clock is now officially ticking on post-merger integration risk. The pressure is on to make those promised synergies a reality.
Now let's flip to the other side of the acquisition equation. We find something called non-controlling interest, or NCI. Please don't just dismiss this as some leftover piece of equity. It's actually a critical window into the company's partnership strategy. It represents a real external claim on that subsidiary's assets and its future earnings, and that's a claim that can have huge implications for future cash flows and even corporate control down the line.
So, the deal is finally done. The ink is dry, the balance sheet is consolidated. Great. Now, the real work begins. We have to evaluate the ongoing performance and the overall health of this new combined entity.
And this brings us to a major analytical challenge. You see, once these companies are consolidated, they start doing business with each other. The parent company might sell goods to its subsidiary at a managed price, or maybe provide a loan with really favorable rates. These kinds of intercompany dealings can seriously distort the performance you see on paper, making it almost impossible to figure out which parts of the business are truly creating value. This table right here, this is how a sharp analyst cuts through all that noise. They don't just take the reported margins at face value. No way. They dig deep into the footnotes to figure out the impact of all those internal sales, the ones that weren't done at arm's length or fair market value. Then they back them out. And what's left is the true underlying economic margin, which is an absolutely critical step in any serious valuation.
So you're probably asking, where do we find all this critical information? Well, it's rarely on the front page of the financial statements. It's usually buried deep in the disclosures. Your analytical roadmap, your checklist, has to include 4 key stops. First, scrutinize how they test their goodwill for impairment. Are they being rigorous, or is it just a rubber stamp exercise? Second, analyze their segment reporting. Are they trying to hide a poorly performing unit inside a bigger group? Third, investigate all the related party transactions. And finally, assess the total risk exposure of the entire combined group.
Okay, now let's connect all this detective work directly to how professionals in the capital markets actually use this analysis to make huge decisions. Why does all this digging around even matter?
Well, if you're the M&A analyst who advised on the deal, your work isn't over when the deal closes. You're using these post-acquisition consolidated statements to track performance against your original model. You're constantly asking, are those synergies we promised the board actually showing up in the margins? Do we get the value we thought we paid for?
Now, if you're an equity researcher, your entire focus is on the future. You are dissecting these consolidated financials to adjust for all those internal transactions and funky accounting choices. Your whole goal is to figure out the true quality of the earnings being reported so you can build a much more accurate forecast for your valuation models.
And finally, we have the credit analyst. And let me tell you, the credit analyst is hunting for risk. They're looking at this whole consolidated entity to understand how cash actually moves between the parent and its subsidiaries. They need to know, are there any restrictions? Where is the debt really sitting? And can the parent company actually get its hands on the subsidiary's cash flow to pay back its own loans?
At the end of the day, we have to see these documents for what they really are. A consolidated statement isn't just a collection of numbers, it's a narrative written by management. It's a story about their strategy, their acquisitions, their integration efforts, and their appetite for risk. The numbers, they're just a vocabulary they use to tell that story.
So the next time you open up an annual report, I want you to remember this. That document in your hands, it isn't a chore. It's a narrative. The entire story of the company's strategy and its future is laid out right there in front of you. The only question is, are you reading it correctly?